But let me sort of just wrap up here. We're seeing, commercial real estate is really caught between a rock and a hard place. The rock being the extraordinary stress on cash flows, declining rents. Rents on Class A office in New York are down 50% from the peak. Vacancies are rising dramatically. Cash flow stress is there. Some of these properties, many properties are protected right now for the moment by long-term leases. That protection wears off over time. So there's a big issue on the commercial side. Let me just fast forward. Oh, maybe just losses. From our work, we expect cumulative losses in the CMBS arena. And one of the things that we're trying to do right now is understand total losses in commercial real estate debt, principally in banks as well, because that has huge impact not only on the commercial real estate market, but on the economy as well. The way we do that is to start by trying to understand what losses will be in CMBS, try to understand the difference between loans in banks and loans in CMBS, and then try to come up with a sort of minimum that we think losses will be on the bank side. So on the CMBS side, this is a summary, what we've got up here. We're expecting for the entire outstanding vintage to be somewhere, the entire outstanding CMBS universe, 10 to 12% losses. Now that's roughly 50% higher than what we saw in the early 90s in life insurance company portfolios. For more recently originated loans, it's much worse, about 15% cum losses. Those numbers may not sound shockingly large, but they are eye-popping, and they have very significant implications. So the question is, what are we expecting to see in banks? And we'll use these sort of numbers to try and get to some ideas. The interesting thing about banks is we've got basically three types of commercial real estate loans in banks. About $530 billion in construction loans, about $1 trillion in what we think of as core commercial real estate, and about $220 billion in multifamily loans. Now, almost everybody out there believes that commercial mortgages in bank portfolios are almost just better quality than commercial mortgages in CMBS. Whether it's core commercial or multifamily, it's a very, very prevalent view. It was certainly the case. Why do we have that view? It was certainly the case, and it was true on the residential side. But there's a lot of differences between residential real estate and commercial real estate. And our view is exactly the opposite. We believe, and I think that this is a widely held view among senior people in CMBS who dealt with banks and dealt with lenders. What CMBS did over the past, between 2005, 6, and 7, was effectively siphon away the best lending opportunities that banks had on the largest properties with the most stable cash flows, leaving banks with a much reduced lending opportunity set. Now, let me just show you some evidence of that. I'm going to skip over this a little bit. This is the exposure of bank portfolios to construction loans. And what one can see is, beginning in 2005, the exposure to banks to construction loans, which are, if there's anything out there in the commercial side that should be called toxic waste, it's construction loans, basically doubled in the period where CMBS grew dramatically. Now, that doesn't prove anything, but it's certainly consistent with our view that what we expect to see in banks is at least as bad as what we expect to see in CMBS. On the core commercial real estate side. On the construction loan side, it's going to be an utter disaster. I mean, we're expecting 20 to 25% cum losses on $530 billion in construction loans. The other thing to note here, let me skip forward again. Again, the real exposure to core commercial real estate and construction loans in banks is in the smaller regional banks and community banks. And that's where most of the problems are going to lie. We're expecting to see many, many hundreds of banks fail due to commercial real estate and construction loan problems. Running out of time here? Okay. So let me just leave you with all of these slides that I'm skipping over are available to people who are interested. But the bottom line is that if you look at how loans are performing, core commercial real estate loans in bank portfolios are performing. The default rates are much higher than they are in CMBS already. On the multifamily side, multifamily loans in bank portfolios are already performing worse. Construction loans redefine what bad performance is. So I think that there is significant reason to believe that commercial real estate, whether it's in construction form, core commercial real estate form, or multifamily loans, are going to be an ongoing problem for banks over the next 5 years. And then the key issue is how banks are going to deal with this. And unfortunately, this is a fascinating topic that I don't have time to talk about in this part. But it will be it will have a key impact on commercial real estate more generally. Thank you.
Great, thanks. Tim, I wonder if we can start serving the alcohol now and after that presentation. No. That's really important and interesting to know, I think, because ultimately the loans that are in these portfolios are going to have a huge impact on the marketplace going forward. And fortunately, we've got my old student Brent Morris. He's going to tell us where the opportunities are in the private debt market. Yeah.
That sounds good. And Dave, you can trust me with the clicker.
Yeah.
I want to get to Kelly's as badly as you do.
There you go. Excellent.
It's great for me to have my real estate professor from business school and my employer for 4 years here. So if I say anything controversial or factually incorrect, I'd like to ask you to please direct your questions to Dave and Brian. And I also want to apologize up front. Some of my slides are highly technical, and I'm going to try and put these complex concepts into simple terms. So this next slide is highly technical, but I think it's a good representation of the current state of the market. So that pretty much clears it up, I guess, for everyone.
Okay, thanks, Brent.
Yeah, that does it for me. But just echoing some of the things. Clicker issue. There we go. Just like everyone said here, we had historic inflows of both debt and equity into the markets. And just as a side, for the last 10 years, I've really been focused on investment in the private debt market, either through originating loans, buying senior loans, buying B pieces, or buying mezz. So after a pretty historic period of capital inflow, we've had, to say the least, a severe liquidity crisis. Any highly levered entity with near-term maturities is under distress. So you could have an asset that's performing well, but if it's above that threshold, $20, $30, $40 million, finding the right kind of takeout financing is difficult, to say the least. Equity and debt capital is on the sidelines. And most importantly for our business, the transfer of risk through securitization through the CMBS market is really not an option right now. That entire market is shut down. In terms of where you can sort of point to the reasons for this liquidity crisis, if you look at it, really the three largest holders of commercial real estate debt are either shut down or have dramatically pulled back their commitments. That's the commercial banks, the structured loan providers, the CMBS, CDO, or asset-backed market, and then the life insurance companies. We're starting to see some of these participants trickle back into the market, but it's nowhere near where the capital inflow was. Just to take a look at it, we've sort of gone through several phases here. And if you look at it, we sort of look at it, the traditional phase was really just the typical plain vanilla bank or insurance company lends 80% on a building. The owner puts in 20% equity. and they go on their merry way. When we had a crisis in the late 80s, early 90s, and values were hammered, you saw the banks pull back. There's a little typo there, but banks pulled back to sort of 55, 60% lending, and they provided this gap for mezzanine lenders to enter the market. And so the mezzanine lender could come in and provide sort of 60 to 75% loan to value on the back of what would be considered a conservative first mortgage, and you could make a mezzanine return in between sort of what the mortgage market and the equity returns were asking to bear. Stage 3, where we were just sort of emerging from, was a period of financial engineering, and you saw some highly fragmented, highly segmented tranches of debt within any one particular deal that was targeted for very specific investor bases. And now, as we've seen, the financial engineering market is really shut down. In a way, we're moving back to sort of the bridging the gap period, where you've got what lenders that are in the market are making very conservative senior mortgages, and so there's potentially the opportunity to step in and provide some mezzanine finance at what we see are fairly attractive risk-adjusted yields. Just to give a quick example of how structured some of these transactions were getting over the last couple of years. This was a major hotel acquisition by a major private equity firm. The collateral was an internationally renowned brand. The equity contributed here, this is all public information, was $4.5–5 billion. So a major investment by one of the largest players in real estate private equity. And if you look at, this is the capital stack for the transaction. There were 10 tranches of mezz. Mezz J alone, we took away the names to protect the innocent. Mezz J alone had 14 separate investors in that tranche. And so, to the extent this ever does need to be worked out, or we're going to have to get all these lenders together with their attorneys to figure out how to restructure this deal, we've reserved some space at Lincoln Financial Field here, which should almost cover the required attendees. So, again, in terms of where we see an opportunity to make some money, if you tread carefully, is in the senior mortgage market right now. I think as Dan touched on, when you look at mezzanine opportunities right now, behind existing deals or deals that were originated in the last 2 years, you're dealing with very light credit terms in a market where you have limited control. Now you really have the ability to step in, if you have the capital, to upgrade markets, to upgrade credit structure, to deal with real cash transactions on, for lack of a better term, today's valuations. So we see a lot of opportunity there. But you have to be more focused than ever on credit fundamentals. And in talking with people in the market, people will say the best loans they ever made were made in the early 90s, and now it looks like you can achieve even better risk-adjusted returns in the current market. Just to give a brief snapshot of what I'm seeing, what we're seeing in the market, life insurance companies had pulled back dramatically. Now, we're seeing them trickle back into the market for the right deals at very low leverage points. Corporate bond yields have pulled back dramatically, so the CIOs for these insurance companies are looking to real estate, as a good relative investment on a risk-adjusted basis for their alternative asset bucket. There's not a lot of quality senior CMBS out there, so they can achieve better yields through origination. But again, it's 60 to 65% loan to value on cap rates that have blown out 200 basis points with very conservative calculations of value and NOI. The one thing that has sort of stayed somewhat steady throughout all this is government agency lending to multifamily. They're still lending in certain markets as high as 75 to 80% loan to value at cap rates more closely associated with where the market was a year or two ago. Still capped by debt service coverage calculations. But the government lending and the ability of this market to stay open has really insulated multifamily from a lot of the significant downturn we've seen in other market sectors. So, quick snapshot, a lot of material on the slide, but, really, it's really sort of a then and now slide. If you look at where we were only 24, 36 months ago, you'd get, a 5-year loan on a transitional asset, LIBOR plus 150, 175 basis points, up to 85% loan to value. There were cash outs left and right, people refinancing existing mortgages. The sizing was based on cash flows that were to be achieved 2 and 3 years down the road. No recourse, no guarantor, and there almost was no property type that was ineligible. Here today in the current environment, we're seeing tighter credit structures, 3 years with extension options, amortization, minimum returns of 7%, 6 to 8% roughly, low loan to values, all cash up front at closing, and in top markets to top borrowers. So it's sort of a difference between credit light and current credit structure, and we really see significant opportunity there. Unfortunately, I am not alone in seeing this opportunity, and this is just, in the private market, it's harder to track. We all sort of play in that space, so we see all the funds that are attempting to come to market. These were just the, some of the entities that had listed shelves for IPOs, specifically targeting first mortgages. Starwood Capital, Barely Sternlich got done, but following his capital raise, it's really been tough for anyone to raise capital. I think Apollo, you see, has raised $200 million. They were targeting $500. Colony targeting $700, raising $250. So there's a lot of appetite, but investors are still sitting on the sidelines, and we're still at a bit of an impasse there. So we see opportunity. If you're careful and you pick the right markets and the right borrowers, we think there's an opportunity to make outsized returns in the senior mortgage market and to capitalize on this lack of liquidity we see.
It's great. Thanks, Brent. We appreciate that. Let me ask you a question about your new bridging the gap. You had first mortgage at 60%, then you had the mezzanine in the 60 to 80% range, and maybe more. Where do you see that pricing in the marketplace today, given what we talked about with private equity required rates of return?
Sure. It's funny when you see, that is starting to be, a sort of mid-teens return, at sort of a base, anywhere from 12 to 15, 16%. So, it differs by property type and by borrower, but, you're getting a risk-adjusted return, which looks fairly attractive right now, because you still have, especially on new deals, where you have new cash buffering you, 20, 25% of cash equity subordinate to your mezzanine piece, you're finally getting a return that's somewhat in line with the risk. Whereas, 24 months ago, that same piece of debt, you were earning maybe 5%.
Right, and what we saw for Richard's stuff is that obviously that wasn't priced correctly. Again, I'm no rocket scientist, but if you've got 16% mezzanine debt, right, on a deal that's up to 80% leverage, what's the equity have to make, right? Equity comes behind that piece, and certainly behind the first mortgage, and the required rate of return on equity, if we're talking about pricing some of these assets, it's maybe 25, 45% is not enough. I don't know. Interesting.
For that kind of leverage, right?
For that kind of leverage,
and it should be. It's high octane risk. We sort of lost sight of that, in the heyday.
Good stuff. Our last speaker is Brian DiDonato. Brian's with Soaring Capital.
Thanks, Dave. Should I use all of the 3 minutes, or do you want to leave?
You got 3 minutes. Well, to be fair, Sean and the dean took a lot of my time, so we're gonna pull back some of that time, and so we'll open up the questions.
So, Soaring Capital is a long-short hedge fund, so we don't. After hearing Richard speak, I became a little depressed, and I thought, well, let's just get shorter, don't get depressed. So I'm not going to go through the slides on statistics. You've seen most of them, and you follow the market, so you know what's going on. I will make some observations that we see in the marketplace. And right now, you have a tale of the haves and have-nots. And Joel talked about Toll Brothers being able to issue debt in the marketplace for a low-levered company. Their ability to de-lever in a tough market is admirable. But their ability to access debt at 6.5%, 7% enables them to grow when others cannot, when the private companies cannot. So the public companies, the REITs mainly, and our specialty is commercial, not residential, but the public companies have a real advantage in this cycle of being able to issue debt now at 6% and 7%, and also issue equity. They have the ability to grow. They will get larger at the expense of the private levered private equity guys. So that's one observation. I will say that we invested in credit markets heavily. We did that this year. You could have bought Brandywine debt, and somebody used that as an example. Dan, I think, used that as an example. We bought Brandywine debt at 60 cents on the dollar back in March, and sold that at 95 cents on the dollar in the last couple of weeks. So that was about a 50-60% return. So that was far in excess of the 25% return you would have gotten in the REIT equity market in 2009. So that's really been an opportunity. Unfortunately, from an investor perspective, that opportunity is pretty much over as prices have become very efficient, both in the public debt space and the equity space. We were, when Fred and I worked together several years ago, we were very short the CMBS market that Richard was talking about. We got short probably pretty early, back in 2005, in a big way, shorting the CMBS market. And that trade worked well all the way through 2007. And now with the rally over the summer, it's probably a good time to get short again in the CMBS market. Richard had a good slide of losses for 2007 originated loans that were going to be about 22%. The bond in that capital structure that's below that, right below that, trades at about 50 cents in the dollar. So it doesn't make a lot of sense. That bond is not going to get any money back, in our opinion, in Richard's opinion as well. So that's a good short in this marketplace. So we look at those opportunities and weigh how we can make outsized returns. And the nice thing is you're liquid. Being in the public markets, you're liquid. In the private markets, you're not. And Dan was talking about trying to raise money, and everyone trying to raise money in the private markets. I know if you all think about your personal accounts, and put the students aside, no offense, but if you think about your personal accounts, are you willing to give somebody money for 10 years in this marketplace? Absolutely not. Right? Absolutely not. You're not going to get money for 10 years. If you could have invested in the equity market in March 9th, right, and returned 50%, right? Why would you give somebody your money for 10 years if they're telling you they're going to give you a 15% net return? It's not. Psychologically, you just won't do it. So the private guys are going to have a hard time raising money. No offense, Dan. I
agree with you.
And the operators that can go public probably should. Because I'm going to show you a slide in a couple of minutes that is pretty staggering on our ability as a country to spend money and devalue our currency and be awash in dollars. So a couple of comments here. REIT debt and equity prices are fully valued. The private markets are slow, virtually closed. Maybe 2010, as Dan said, he had good observations on that. We agree. Maybe 2010, the private markets will start transacting again. But as Brent said and Richard said, without the banking system, it's going to be very challenging. Without the securitization markets, that's actually where I got my start as a bond trader in the securitization markets in the mid-1990s. And for the students in the room, you should think about that. The securitization markets will come back. They'll come back in a big way. They need to come back. And it will be an opportunity over the next 10 years as the securitization markets grow from nothing today to probably another $700 billion market over the next 10 years. Property fundamentals will be the ultimate determinant. So we trade securities, right? But it's all about what the ultimate NOI is going to be and what somebody's going to be willing to pay for that cash flow, right? You know, the simple example of a $10 million NOI in a property, you could value it at a 10 cap, it's worth $100 million. You can value it at a 5 cap, it's worth $200 million. Which one's right? It depends, right? What are you willing to spend for that $10 million of NOI? And the last comment is an overriding theme we have on a macro basis. Cheap money and the weak dollar should inflate real assets over time. This is a problem as our country, and I'm not making a political statement, it's just a fact, as we increase our national debt to $10 trillion over the next several years, it's a problem. It's a problem from a currency perspective that will inflate real assets over time. I'm not going to spend any time on this slide. Just that one blue line is your cap rates. And cap rates today, 7 to 8%, that's not a disaster, right? And this is a long slide, going back to 1990. They're still relatively low, right? The insanity of the last 5 years of financing available that drove up property values, 7.5 is pretty good with a 10-year treasury at 3.5. That's 400 basis points over the 10-year treasury. The REIT market, the public REIT market, the reason I say it's fully valued, if you look at the dividend yield in the public REITs, it's about 40 basis points higher than the 10-year treasury. Not that attractive, right? So you're not going to just jump in and say, okay, here's my money, got 40 basis points more than the 10-year treasury. You wouldn't do it, we wouldn't do it. One reason is you will do it, or you would do it, is because they can raise public debt at 6%, 7%, and they can raise public equity, and they're going to be the ones to be able to buy distressed assets. One I like to point out is Vornado, who can raise public debt and can raise public equity, and they just announced a couple months ago that they want to raise private money of $1 billion or $2 billion in private monies, which just makes no sense, right? When they can raise public money, the reason they want to do it is they get paid better, frankly, in the private money than they do with the public money. The public money is more discerned by REIT investors and public equity investors, so I think it's more of a selfish motivation here for management. But I think they probably won't raise a lot of private money, and they will be back to the public markets, raising public debt and public equity. This is as Joel said, Toll Brothers is able to raise money at 6.5%, 7%. And that's true with all the investment grade REITs. It really is paying to be investment grade and be a little levered in this marketplace. And they're going to be able to grow. Brent talked about this slide. I just want to point out one thing, and for the students in the room, what my point was the commercial banks have, on the far right in 2009, this is where the loans are, the $3.5 trillion of loans in the commercial space. The majority of them still are in the banking system. And we agree that the next 2 to 3 years, the banks will be working through those problems rather than making new loans. The box above that, the ABS, is a securitized market, about $750 billion. And this is the market that's currently closed, obviously, and will be an opportunity for the students in the room as that business grows again over the next several years. The long-term determinant of NOI, of value will be NOI. So an example that I gave of a $10 million property that could be worth $100 million or $200 million, it really depends if that's really $10 million, $9 million, or $8 million. In 3 years, what the true value of that property will be. And we don't know what that answer is. I will say that these are general comments. Obviously, each of the markets is different. Dan mentioned the multifamily market, and they do trade at 6 and 6.5 caps because the federal government is willing to lend them money at 5.25%, at 70-75%, despite the fact that Fannie and Freddie are both insolvent. They're still willing to lend that money at 5.25%, 5.5%. So you're going to pay a 6 cap, assuming you're going to be able to raise rents over the next several years, given your rents are probably down 10% in the last 12 to 18 months. The multifamily is a different sphere. We call it a commercial property type. I really like to speak of it separately, except for the apartment REITs like Avalon Bay that Dan mentioned. The fact that they can issue public debt as well as tap Fannie and Freddie for financing and lines of credit is a true opportunity for them. And then, so most of the conversation is really about the office space, the retail space. The hotel space is, again, an operating company that's in a total different sphere. It has a whole host of issues, mostly economic and an inability to finance that sector right now. Although in the public market space, if you look like Starwood Hotels, the stock is doing great. I mean, it's back to probably a several year high point, probably back to 2005 levels. This is my favorite slide that I picked up off of Bloomberg this week. This is the money, this is the Federal Reserve's own statistics of money at zero. And what that means is money sitting in checking accounts, money sitting in money markets, not doing anything right now. It's a staggering number, $9.5 trillion. The U.S. savings rate is going up, and we're approaching 8%, given fear of investing your money. So 8% is the savings rate right now, and people expect it to stay that way. This $9.5 trillion is going to grow. So the question, I think, and this is the question of the statement, is where is this money going to go, and when is it going to come into the marketplace? Is it going to come into private equity money for 10 years on a total discretionary basis at 1.5% fees or whatever the new fees are and 15% of profits? I don't think so. I think it's going to go overseas. I think it's going to go into public opportunities. It's right now piling into the debt markets. Despite the low yields on corporate debt, still going into the debt markets. People that follow the equity markets think the equity markets had a tremendous run from March 9th. I will tell you, if you invest in credit funds, they have massively outperformed the equity markets in 2009 by about 15%. So there's still money going into the credit markets. What happened in Japan in the late 90s is the money went in. The Japanese are great at saving. Yields went down, they stayed down, and cap rates on properties went down to 3% in the years 2005, 2006 in Japan. It was a tremendous savings rate. Those are some general comments.
That's great. Thank you very much, Brian. Appreciate it. We've heard a ton of different opinions about what's happening, what's going on, and heard some opportunities in the housing market. We've heard from Brian about some of the opportunities out there. But there's obviously sort of no consensus unless it's that there are some bad things going on out there. And the question, and I appreciate you guys sort of talking about this, is where are we going to go into the future? At this time, I'd like to open it up for questions. Who's got some questions out there? I can ask questions all night, but if I could get some questions from you guys about where you are or where you live. Yes, sir.
I'm actually I have a view that people see cap rates move back down to the lower where they were 3 or 4 years ago, largely due to inflation and a similar Japanese issue. That's a crazy thought. I think I would be very interested in the craziest forecast that each of you might have.
Dead silence. This is Chris Haley. Chris, he was asking if you didn't hear from the back, basically that he said that he sees cap rates going down to sort of areas where they were or lower.
Unfortunately, I think our view is that equity will be a significant portion of the marginal deal for some years to come.
Mm-hmm.
And that equity will be asking for a lower rate of return relative to alternative investments. And real estate assets will fill a greater void, or will fill a void that is partly mentioned in Brian's view. Now, that's somewhat nutty because the countervailing view is higher inflation due to government spending.
Right.
So that's just something that we have. I wanted to take that off the table. That's our view. I'd be interested in a crazy view that you just think has a low probability over the next 5 years.
You want me to go first? Let me go. This is a crazy view, and I prefer to take the optimistic crazy view than the pessimistic crazy view. Let's see, the consumer comes roaring back and decides that they want to spend some money. Although personally I don't see that. I think these people have overspent and their house values are down. So let's assume they all come back, they start buying. Some crazy industry gets created and creates job growth. That'll drive everything. And most importantly, Washington decides to create some rules that we can all live by and understand so investors can make intelligent decisions. Because we don't know what taxes are going to be. We don't know where we're going with healthcare. We don't know where anything is going at this point. What are capital gains costs going to be at this point? I have no idea. How do we make a decision on what the return on our investments are? So let's assume Washington gets straightened out, consumers come roaring back, and there's a new industry, and we get job growth in the next 2 years. Then it'll make you feel better.
And what will that do to, and what will that do to cap rates? What do you think that's going to do to cap rates?
Well, let's see.
I think that was his question.
Yeah, that's an interesting question.
You know, the answer to cap rates are just
I would be happy with all that. I assume that we'll hit some equilibrium. I would be happy with that whole scenario.
I think we have a lot of contradictory data that kind of talks about that issue. One is the prevailing belief that we will see inflation in the future because of all the borrowing that's taking place now, and I do believe that will take place. When you see lots of inflation and you have real assets, eventually those real assets show growth. It may not be at the beginning of the cycle, but eventually real assets see growth. So if you are an investor and you're betting on the growth in the asset as compared to the cash flow, you may get to see cap rates change if you do cap rates on income, because income doesn't include appreciation on the real asset. But I think long term it's unlikely to see a return of the kinds of cap rates we saw because I don't think we'll see a low interest rate environment that allows the leverage to take place.
Richard, you got anything crazy?
Well, I have a view on cap rates. Hopefully it's not crazy. Instead of giving you the craziest guess, why don't I just give you my guess on cap rates? I think we've all been incredibly surprised by the return of the appetite for credit for the past 3 months, the kinds of rallies that we're seeing, the kinds of pricing that's getting done in high yield. That sort of gives me pause a little bit because my assumption has been, and I guess it still remains, that cap rates are going to remain wide for a number of years, probably at least 3 or 4 years, because we have so many problems to work out on the distress side. We've been talking about when will distressed assets appear. Well, we're only 6 to 8 months into this problem. We're in, sort of to use an analogy, we're in the second inning in the commercial real estate's sort of down cycle here. I do believe that we will see tremendous stress. We're seeing it now. I think it will grow, continue to grow, and I think it'll be augmented by these refinancing issues. And as capital markets do come back, because you can certainly make good loans in this kind of environment, I believe the capital markets will begin slowly to make its way back, and I believe that banks in many situations will be forced to reappraise and reserve for a wide swath of problem loans, and that will allow them to be in a better position to actually sell those loans out at some point. It is a waiting game, and that's why we're not seeing a tremendous amount of investor interest in these distressed funds at the moment. There's no distressed opportunities. I think it's a mistake to assume that they're not going to materialize. I think they will, and I think that they will. This kind of environment will put pressure, will keep the pressure on cap rates.
Wildly diverging ideas. That's interesting. How about some other questions? Yes, sir.
What are you guys' projections for interest rates? The Treasury's on for the next 2 years and say 7 years, 5 years.
Maybe we'll go down to our capital markets guys at the end.
I think we will, the Fed will keep LIBOR next to 0 for 2 years. That was probably a contrarian view until the second half of 2011 to let the regional banks earn their way out of their commercial real estate problems. The Federal Reserve, through the Real Estate Roundtable and Congress, knows commercial real estate's a problem. And the only way to do that is to keep deposits at yielding 0 and letting them lend at 5 or 6% and letting them earn their way out of the problems. And Richard's right, they have a lot of problems. Whether those actually materialize or not, where they can just turn them out and hire guys like Dan to take over the properties, which is probably a real scenario. You may not see as many opportunities as you think. I think the 30-year Treasury, right, which is right now about 4%, I think will stay below 5% for the next 5 years, because I think there'll be too many dollars chasing yield, and they need to put it somewhere. I think it will create an equity bubble. So low. The answer is low. I don't know how low.
Anybody in inflation, Bear?
Well, I think most of the people at the Federal Reserve are inflation bears right now. I think that the staggering amount of assets that these core I can't remember what they're called, the core holdings at the Federal Reserve, is scaring everybody. I think inflation's a real issue. And that could put pressure on long-term interest rates, for sure.
Thanks, guys. How about some other questions? Yes, sir.
Deficit borrowing by the federal government. Do you think that'll push interest rates up over the next couple of years? Won't the 10-year T-bill go up?
I would expect so.
Somebody buys it.
Again, I
would expect
think we have
yeah.
wildly diverging opinions. I guess I've been giving talks to some places around, and I came of age. I got my first mortgage in October of 1981. real clever that one. When fixed rate
It's only
mortgages,
gotten better.
18%.
fixed rate mortgages were 18.5%, and I was sucked into a teaser. I was on the cutting edge of the mortgage market. I got a 12 3/8% teaser with negative amortization. As we see the credibility fly out the window of your moderator here, and which sadly makes me a perpetual inflation bear. Obviously it's been the wrong bet for about 20 years, but you know, part of it's related to exactly what you see. I mean, there's an article in last week's Wall Street Journal about people going after tips, the Treasury Index, inflation protection securities, and there's a broad swath of the population, I think, that thinks somewhat like me, that that's a real risk. I mean, Brian, you've sort of told us at least in the next 5 years that maybe that's not something you see.
Well, I don't think there won't. I think there'll be commodity inflation because I think the dollar will devalue. If you keep interest rates low for a long time, your currency will get weaker. It's just a fact, right? Because people won't want to buy your 2% treasuries, put their money somewhere else. So commodities will inflate in price. We're not a commodity-driven economy. Even less and less every day. So you will see inflation in real assets, commodities, less so in real estate, I think, because of the ability to finance real estate.
Some you agree with, Joel?
Yeah. I think there are two ways the government finances the programs they have. One is you pay higher interest to attract the money to finance the country, or the second is you devalue the currency, and I think we'll see both. So if we don't see very high interest, it's only because we're devaluing the country, which will effectively be higher interest because our dollar will buy less. So if you talk about it in real terms, I think that we'll see a real interest rate that's significantly higher if you count deflation of the currency.
Interesting. Who wants to ask the last question tonight? Yes, sir.
There was a comment that the securitization market would return and expand, and I'm just curious as to the form you think that might take, the underwriting that will be applied, who will hold the risk, how will it be shared, structures, things of that nature.
Yeah, I take a first cut at it. We're starting to see some cracks in it in just base securitization of transferring senior risk to another party. So I think the way it's going to start to crack is going to be the base mortgage itself is going to start out as a fairly conservative vehicle in and of itself. And then however you lay off the senior portion of that debt, the issuer or the originator of that debt is going to be responsible for retaining a portion of that first loss risk piece. It's not going to be the same, just production machine that we saw in the past where every ounce of the capital stack was sliced and diced and sold off. The CMBS machine made the fees and had zero of the risk retention. So I think like it was when Brian was sort of first in the market back in the Stone Ages, it's going to be originators and issuers of those securities are going to be forced to have significant risk retention of that lower tranche of debt. So I think that's how it's going to start to break. But I think as Brian was saying, there's a lot of capital on the sideline looking for fixed income investment. I think seeing the herd mentality here through CMBS and CDO issuers, once it does break, you can see a pretty significant capital flow there in the years to follow.
I'm a firm believer that securitization is a good thing. It's as long as you manage the process, manage the risk. We did see the process just go nuts. I was in the room, Jim was giving me grief about this, but I was in the room when the first CMBS deal was ever done in April of '87, Solomon Brothers, and I was a fly on the wall when all these other guys were sort of making it all up. And the first deal was on a bunch of multifamily properties in Southern California, where the issuer retained about 25%, the 25% first loss piece of that. There were 3 tranches that were sold to knowledgeable investors, right, with respect to the risk that they got. There was a AA piece that went sort of to the investment grade market. There was a BB piece that went to the non-investment grade market, and there was a non-rated piece that ultimately ended up, in the hands of somebody who truly understood the underlying real estate risk within that, within the collateral. And I think what we saw, obviously, this is no surprise to anybody, is that the whole thing just ran amok in terms of carving and slicing and dicing. At its heart, I think securitization is a good thing. At its heart, I think tranching risk to meet risk clienteles is a good thing. But only as long as everybody in the process truly understands what they're going to get and who's making the fees. I don't know. I mean, we have an investment banker here. I don't know if anybody would have an alternative.
Well, I have I'll just add a couple comments there. First of all, I think that I think what we saw over the last 3 or 4 years, well, 3 years, was a pretty widespread. It was a credit bubble. It was a credit bubble not only in securitization, but in more fundamental assets as well. That's why what I believe we're going to see in banks is so important, because what this will show, certainly banks hold equity in these investments. They hold first loss pieces. And it will be, I think, quite instructive to see that it's not simply the securitization markets that sort of ran afoul of common sense here. It was pretty widespread. On the other hand, I do expect securitization markets to come back. I don't believe that they will come back if banks are required to hold equity, first loss equity. There's simply, banks aren't set up to warehouse that kind of risk. That's not the kind of business that they do. And forcing them, which is sort of the current, those are part of the current Obama regulatory proposals on the table, will effectively kill securitization.
Interesting. Well, gentlemen, first I'd like to thank Jim Danko, and the team here at Villanova, Sean and Tim, for hosting this fantastically good event. We really appreciate it. And thanks to our panelists. Please give them a round of applause.